Welcome to Business with Louis, the show where we break down complex business concepts into actionable advice for entrepreneurs and students alike. Today, we're going to explore one of the most fundamental principles in finance: time value of money. This concept is crucial for making informed decisions about investments, loans, and business opportunities, so let's dive right in. Time value of money refers to the idea that a dollar today is worth more than a dollar tomorrow. This might seem counterintuitive at first, but bear with me. The reason for this is that money has potential earning power. It can be invested to generate returns or used to purchase assets that appreciate in value over time. As such, having money now allows you to take advantage of opportunities that might not be available later. The origin of time value of money dates back to the 17th century, when merchants and traders first began to understand the concept of interest rates and compounding returns. Since then, economists like Irving Fisher and John Maynard Keynes have built upon this foundation, developing theories and models that help us better understand how time affects the value of money. At its core, time value of money is based on a few key principles: present value, future value, and the discount rate. Present value refers to the current worth of a future sum of money, while future value represents the potential worth of an investment or asset at some point in the future. The discount rate, which can be thought of as the opportunity cost of investing, is used to calculate these values. One influential thinker associated with time value of money is Milton Friedman, who argued that rational investors should always choose the option that maximizes their returns, taking into account the time value of money. This idea has had a profound impact on modern finance and investment theory. So, how does time value of money play out in real-life business scenarios? Let's consider a few examples. Suppose you're an entrepreneur deciding between two investment opportunities: a high-risk startup with potential returns of 20% per year, or a low-risk bond with guaranteed returns of 5% per year. Using the principles of time value of money, you can calculate the present value of each option and compare them to determine which is the better choice. Another example might be a company like Amazon, which has consistently prioritized long-term growth over short-term profits. By investing in new technologies and expanding into new markets, Amazon has been able to generate enormous returns over time, far exceeding what they would have earned if they had focused solely on maximizing quarterly earnings. To apply time value of money in your own business or career, here are a few practical tips. First, always consider the potential future value of an investment or opportunity, rather than just its present cost. Second, be aware of the discount rate and how it affects your calculations. This will help you make more informed decisions about borrowing, lending, or investing. Third, use tools like present value calculators or consult with financial advisors to help you evaluate different options. And finally, don't be afraid to take calculated risks. Sometimes, the greatest rewards come from investments that seem uncertain or unconventional at first. In addition to these tips, it's also important to understand some related business concepts, such as net present value and internal rate of return. NPV represents the difference between the present value of an investment's benefits and its costs, while IRR is the discount rate that makes the NPV equal to zero. By mastering these concepts, you'll be better equipped to evaluate opportunities and make informed decisions. To further illustrate this concept, let's consider a case study. Suppose you're considering starting a new business that requires an initial investment of $100,000. The expected return on investment is 15% per year, and you anticipate the business will generate cash flows for the next 5 years. Using a present value calculator, you can determine the present value of those future cash flows and compare it to the initial investment. If the present value is higher than the initial investment, it's a sound financial decision. In conclusion, time value of money is not just a theoretical concept. It's a practical tool that can help you navigate the world of finance and make smarter business decisions. By grasping this fundamental principle, you'll be better equipped to evaluate opportunities, manage risk, and grow your wealth over time. Remember, every financial decision you make involves a trade-off between present and future value, so make sure you're making choices that align with your long-term goals. As my colleague Warren Buffett once said, "Price is what you pay, value is what you get." Understanding time value of money helps you recognize the true value of your financial decisions and make choices that create lasting wealth. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.